The U.S. banking crisis seems to be getting worse and worse each passing day. The collapse of Silicon Valley Bank is not something hidden from anyone. And with the current economic situation, two more banks are on the edge of a downfall. Have you ever wondered why things are getting tight for the U.S. banks? Or why the Federal Reserve isn't doing anything about the situation? Is the Federal Reserve itself the reason behind the collapse of these banks? Well, if you're interested and want to know the actual cause of all these downfalls in the US banks, then stay right here and watch this video till the end to know all there is to know about it. Despite recent promises from financial authorities and financiers such as Jamie Dimon that the peak of the recent crisis has passed and the financial sector's health remains solid, ambiguity continues to plague the business. Following the government takeover and resulting sale of First Republic Bank to JPMorgan, bank shares have dropped down on Wall Street this week. It was the second greatest financial failure in U.S. history and the third in 2 months for a small bank. While many believed that the sale of First Republic would put an end to the who's next discussions, investors are clearly maintaining focus on remaining players who are considered to be the most valuable. But that's not all. The greater concern is that bank failures will cast doubt on generally solid banks, resulting in a financial pandemic that will affect the overall economy. To avoid this eventuality, the United States tightened regulations on the biggest banks following the economic meltdown that occurred 15 years ago. It's tough to ignore the current era of anxiety in banking, and with current interest rate hikes done by the Federal Reserve, things are expected to get even tougher than they were before. On the whole, this will not be great for the US economy, and that is something we should be concerned about. And there's another thing as well to be worried about. The current banking crisis is not over yet. Bankers and authorities have been trying in vain to persuade investors that the most severe phase of the crisis has passed. Dimon of JPMorgan remarked on Monday that he thought this part of the financial meltdown of the banks was finished. Last week, Jerome Powell, who is the chairman of the Federal Reserve, verified the banking system's health. But the reality we're seeing and the reality they're suggesting are not the same, and that is something frightening. Even now, 2 other regional banks in the USA are on the verge of collapse as the banking crisis continues to linger on. Now, what exactly are these 2 banks? The PacWest and the Western Alliance are 2 of the mid-sized banks in the USA making headlines these days, and both are thought to be on the brink of collapse. The latest sell-off centered on PacWest and Western Alliance Bank, 2 minor regional financial institutions whose stock prices have been in decline since Silicon Valley Bank collapsed in mid-March, sparking the present crisis. PacWest plummeted 51% after admitting it was thinking about selling itself. Now you might be wondering why. PacWest came under attack because of the large number of big, unprotected deposits from venture capital and technology clients, the same consumers who sparked the financial crisis at Silicon Valley Bank and First Republic. According to reports, 23% of bank deposits came from such sources. PacWest, which is headquartered in Los Angeles, and Western Alliance, located in Phoenix, both issued statements overnight stating that they were not experiencing any unusual deposit withdrawals as a result of the sale of First Republic. However, each of the banks witnessed big outflows after Silicon Valley Bank's bankruptcy, although both report deposits have risen since March 31st. Western Alliance released an additional statement in the past week, arguing against a Financial Times report that the bank is looking into a sale, but its stock dropped 38% soon after. Is it a sigh of relief that these banks are denying these claims made by different reports? Well, no, we should not be comforted. In fact, the thing that most of the shareholders are concerned about is that PacWest could follow in the footsteps of First Republic, which wasted weeks hunting for a buyer before folding. First Republic likewise marketed to a rich customer base, many of whom withdrew money as soon as Silicon Valley crashed. The recent sharp increase in interest rates has also affected the value of big loans made by the bank when rates were significantly lower. In the same regard, different banking industry experts such as Chris Caulfield have said that these large deposits are not going to guarantee the sustainability of a bank. These banks are often seeing the deposits running out, and in return, these banks have to pay large amounts to cover up the loss. But why exactly are these banks under such pressure? Well, if we sum it all up in one word, it would be liquidity. This is the kind of problem that is being faced by a bank when there's no money, or the money that is available isn't enough to take care of all the needs of the bank itself and the shareholders. Due to the hike in interest rates, which was done by the Federal Reserve, the majority of the American banks are facing the same problem. Many of the lesser-known regional banks that are under attack, like the three failing banks, have deposits that are too big to be guaranteed by the Federal Deposit Insurance Corps. Investors are also concerned about undelivered losses in banks' portfolios, which include bonds issued by governments that have declined in worth since the Fed began aggressively hiking interest rates last year. They are particularly concerned about banks' dependence on weak business mortgages, as offices around the country remain idle. The financial community is concerned that these banks will be unable to sustain a large drain of deposits if clients flee to the apparent safety of larger institutions. Many of the investors placing bets against these smaller financial institutions are those who are selling short, or those who place wagers that regional bank shares will fall in value. Banks, on the other hand, have reacted by attempting to reassure consumers and shareholders that they are well capitalized. In one of the Fed reports, Jerome Powell said that the US banking system is sound and resilient, but it doesn't look like it. Is this the reason this reassurance isn't calming any nerves? Well, apparently yes, and we have fear to thank for that. At a moment when the economy as a whole is shaky, there is still a lot of confusion about the stock market's future. The Fed has begun its most aggressive rate hike since the late 1980s. And while the Fed indicated in the previous week that it might have stopped raising interest rate for the time being, there are rising concerns that rising borrowing prices, in addition to banking turbulence, will send the economy into a slump. However, there is still a troubling gap between what the accounting records of the targeted institutions truly indicate and what the financial media perceives. Yet some experts still believe that stock fluctuation does not predict deposit fragility, but we'll have to wait for time to tell us what is actually right. Not only that, most of the aimed banks are searching for extra purchases to back up liquidity. PacWest said in a statement that it is in discussions with several prospective collaborators and investors, and is exploring selling a few of its properties. Meanwhile, Western Alliance categorically disputed a media allegation that it was considering a sale. It describes itself as financially sound and stable, and said that the bank is doing okay. But, on the other side, most bank analysts and executives on Wall Street want the Federal Reserve to take action and to intervene to ensure more flow of money and liquidity in the banks. But is it going to help the situation? When the Federal Reserve itself admits that the bank has made a few mistakes, which have led to the current banking scenarios, it seems like the Fed is already dealing with its own problems. It is now being said that the problems could have been addressed in a more efficient way, and that the Fed could have done better. So, will it all come to an end, or will it continue to get worse? Right now, it is very hard to say. A sustained drop in share prices might threaten these smaller banks, prompting clients to withdraw their funds and starting the type of bank run that speculative traders are anticipating. This would increase the urgency for the government to intervene once more. Authorities took the groundbreaking measures of guaranteeing all deposits at Silicon Valley Bank and Signature Bank, even those above $250,000, claiming that the bank's failures established a risk to the banking industry as a whole. In the context of the First Republic, however, the government was determined to come up with a private sector solution. It went through a quick sale process, which JPMorgan Chase won. Any extra government involvement would be problematic because it would increase prospects of a governmental savior. So, what do you think about all these banking problems? And what do you say should be the way to address these problems? Let us know down below. If you found this video interesting and informative, then hit the like button, share it with your friends, and subscribe to our channel. And when you subscribe, don't forget to turn the notification bell on to stay updated with the latest economic news and updates. Thanks for watching.